in most cases, you've got these, we'll call them large pallets of silver 1,000-ounce bars. And on that whole pallet of however many bars there are, I never counted them, there's a tag that says HSBC. And then someone stands for delivery and they take off the HSBC and they put on JP Morgan on it, and the silver never moved. But ownership did, but it never left the warehouse. The only way to track that is to see how many semi-truck trailers come in there and actually take it outside of the COMEX warehouse. And that part of the activity has changed as well, more than before. I mean, just on the input, when you're sitting there and all these, semis pull up to COMEX warehouses and there's more than one of them and delivers 1,000-ounce bars, and someone's got to, take a forklift and move them in and put them in a pallet or on a shelf. That is a physical movement that increases the silver supply. And that's what took place. So someone say that it's all a paper change is incorrect in this instance. I did it on my weekly perspective. For those that don't know, I do a lot of, information or education for free. I do what's called a weekly perspective at the end of every week. And I touch on different things, but almost always I touch on the metals. Sometimes I touch on geopolitics or what have you. But last week I talked about the ebbs and flows in the silver market. So going back to the big picture. In the futures markets, if you look at the softs like cocoa and cotton, or you look at the ags like wheat and soybean oil, or you look at the metals, any of those sectors, usually you only get about 1% of the total that actually gets a delivery against the contract. So 99% of the time, you're just pushing paper back and forth. And that's what the futures market is. It's a derivatives market where settlement is almost always in cash. There are exceptions. There are deliveries of cotton and cocoa and silver. So on silver specifically, we have seen a big change over the last year or so. And this was primarily, and there's arguments about why the silver moved from London into the COMEX, but it's primarily an arbitrage opportunity. And the big players that own the silver physically are able to take these boatloads of silver and move it from a location to another location and still make a spread on it. So that's what happened. And the inflows and outflows have just been above normal. I mean, anyone that's objective and can count knows that that's a fact. In fact, in the weekly perspective, I believe last week, I went through the numbers. I don't have them memorized, but we've had a significant more activity in and out of the COMEX over the last, like I said, year or so. And I did note that, I watched the flows rather carefully, not as avidly as I used to, but I still pay attention to it. And whenever we got to the registered category, which is the amount of chips that the registered category, being the dealers, have available, when that gets thin, it's like playing poker and you have a big stack of poker and you're losing the game, and all of a sudden your stack goes way down. And that indicates that they don't have much physical silver to deliver into someone standing for delivery.
Over the past year, silver's flow into and out of COMEX has picked up dramatically. Arbitrage, capitalizing on price differences across markets, has played a starring role as major holders physically transported silver from London to New York to lock in profits. These flows didn't go unnoticed. Inventory levels, especially in COMEX's registered category, the supply eligible for delivery, plummeted to record lows. When that happened, alarm bells rang for market watchers. Recent data confirms sustained surges in both inflows and outflows, underscoring that behind the paper market, real metal is on the move, quietly but vividly.
And it got down to like the lowest level I'd seen in a very long time, and it stayed there longer than I'd ever seen before. And I made note of that to my subscribers, and probably publicly, I don't remember. And pretty much after the words were out of my mouth, we start to get this huge build in the overall categories, primarily in the registered category, and primarily from the LBMA. So those are facts. But the one I want to stress is after Warren Buffett bought 129.7, rounded up to 130 million ounces off the COMEX, he actually only delivered 90 million instantly. And he took the offer, I guess, to get the rest, the other 40 million over time. And if I remember correctly, someone can check me, but I think it was after that, I'm pretty certain it was after that, there was a limit on 7,500 contracts that you could take off the exchange. Now, I think that's gone away because we haven't seen that in quite some time. But the exchange is kind of protecting themselves because they wanted to prevent someone coming in and buying up the whole silver supply and saying, all right, we're sending for delivery. So whether that holds now or not, I just want to bring that to everybody's attention. So the bottom line is this. It is a fact that the ebbs and flows in silver, gold as well, through the COMEX has been greater these last years or two than it has been previously. That's just a fact. Whether someone says it's normal, I'd say it's quote unquote normal in air quotes, as long as everybody that stands for delivery gets their silver or gold in a timely manner, then yeah, of course it's normal because it's supposed to be, as stated, available to anyone who stands for delivery to get the product, whether it's cocoa or cotton, soybean oil or silver.
One notable episode brought the silver story into sharp relief. Warren Buffett's firm quietly procured nearly 130 million ounces of silver from COMEX. Yet only about 90 million ounces were delivered immediately. The remaining 40 million were arranged for gradual delivery. Following that, there were rumors of a temporary limit, 7,500 contracts, that could be removed from COMEX in a single go. That restriction suggested exchange managers safeguarding against a single actor hoarding too much supply. While it's unclear if that cap still exists, its temporary institution reveals how seriously officials took the risk and how thin the margin of physical availability had become.
In most cases, you got these, we'll call them large pallets of silver, 1,000-ounce bars, and on that whole pallet of however many bars there are, I never counted them, there's a tag that says HSBC, and then someone stands for delivery and they take off the HSBC and they put on JP Morgan on it, and the silver never moved. But ownership did, but it never left the warehouse. The only way to track that is to see how many semi-truck trailers come in there and actually take it outside of a COMEX warehouse. And that part of the activity has changed as well, more than before. I mean, just on the input, when you're sitting there and all these, semis pull up to COMEX warehouses and there's more than one of them and delivers 1,000-ounce bars, and someone's got to, take a forklift and move them in and put them in a pallet or on a shelf. That is a physical movement that increases the silver supply. And that's what took place. So someone say that it's all a paper change is incorrect in this instance.
Titles on metal may shift, but what truly signals real demand is physical movement. At COMEX warehouses, silver doesn't just vanish or teleport. It's loaded onto semis, forklifted, palletized, and transferred from one custodian to another, HSBC to JP Morgan, for instance, without ever leaving the vault. Recent upticks in in-and-out traffic show that silver's trajectory is more than abstract. It's tangible. Those visible forklifts and trucks reveal a market where the scriptwriters are not just speculators, but also investors, refiners, and institutions who move real metal when speed and certainty matter most.
Yeah, well, this is where you got to put on a tinfoil hat. I guess I'll put a black one on here and make the statement. So what it indicates to me is that I looked at the COMEX once I understood how it really worked, with 99% just being a paper push, that anything that came off had some substance to it, because I look at it as, and you don't have to agree, it's kind of the place of last resort, the last place you're going to take the silver, and not necessarily, but it's certainly not the first place. I mean, anyone that's in the industry, be it a fabricator for silver shot or screen or wire or all the different fabricated things that silver goes into, which is vast, they get it usually direct from a refiner or smelter, and they do what they do. They don't ever take it off the COMEX. And so who takes it off the COMEX? First of all, very few, but those that do usually are for investment purposes, but not always. But let's say you're in industry and you can't get it anywhere else. Well, there it is. Stand for delivery. So that implies, but doesn't guarantee, that the supply chain, I wouldn't say is breaking down, but more than the usual amount is coming off the COMEX, which implies, again, I can't put it into a proof formula that we're looking at more silver taken off, because it really is a place to go to get it, especially in a timely manner. Maybe you called up a refiner and said, hey, we're at this level and it's going to take, 4 weeks. Really? Okay. Well, I could get delivery next week if I just stand for delivery or whatever. So again, I'll make it an implication. I'm wearing a hat. You can take it for what you want, but that's what it shows me. And this has happened in others. I mean, there's others. It's called rapeseed oil. It's really canola oil. And there was a shortage a long time ago, and that market went just absolutely ballistic, like palladium did at one time. But it was what I call popcorn rally. It went from here to almost straight up. The deliveries were made and it came right back down. But it does happen, and it is happening, and I'll take off my hat and continue.
Beyond the mechanics lies a deeper story, the integrity of money itself. When currency erodes, as it has over decades, the link between savings, value, and individual freedom frays. Historical and modern examples from Venezuela to broader monetary decline underscore that trust in money underpins civil liberties. Holding assets like gold and silver transcends investment. It becomes a vote for sovereignty. As central banks accumulate precious metals and digital currencies expand, the tug-of-war over control heats up. Whose money is it? Is it ours or theirs? The outcome matters far more than portfolio returns. It could define whether future generations stay free or become subjects of a technocratic order.
There's an old truth at our peril: when money loses its integrity, freedom soon follows. Throughout history, the erosion of honest currency has marched in lockstep with the erosion of civil liberties. The connection is not coincidental, it's causal. Because money is not just a medium of exchange, it's a lifeblood of voluntary action. When it's corrupted, everything downstream begins to decay. Professional agency, self-reliance, and ultimately freedom itself. In a truly free society, individuals make decisions based on trust. They trust that the fruits of their labor, measured in quote-unquote currency, will retain value over time. They trust their savings will serve as a source of wealth, not a melting ice cube. They trust investments will respond to real-world fundamentals, not the whims of unelected technocrats operating behind closed doors. So it's a rigged system. I go into what you just alluded to with Venezuela, the Weimar Republic, and you lose basically your freedom and you get a tyrannical government and civil unrest. And that's the direction we're going toward. And to back up, Catherine Austin Fitts talks about, all the people that talk about the dollar is collapsing or failing. It is failing. I think I push back on that word, and I'm not sure she even uses that word. I mean, it's worth about 1.5 cents of what it was in 1913. So certainly holding its value, which is one of the mandates of the Federal Reserve, it's done a miserable job. Whether it'll fail completely, I highly, highly doubt that. I do believe that we will transition into a new system before we get a complete failure. But that doesn't mean that the market won't react as if it's going to fail completely. And that's where you get into what von Mises calls the crack up boom, where I'd rather buy, 5 jars of peanut butter and some tuna fish rather than keep the currency, because I know that, or believe that currency is losing value so rapidly. I'd rather have something of value rather than hold the currency itself. Will we get to that point or not? I don't think we will get to that point on a mass psychology basis, but I think we're already seeing it, as you alluded to, from the bigger players, the smart money, like what happened with gold. When I said the run to gold has already begun, which I was correct. And we saw the major central banks buy gold at a substantial rate above and beyond what they'd done in the past over the last year and a half or two. And now we're starting to see it in the silver market.
We stand at a crossroads where the erosion of monetary trust could usher in control, unless we reclaim the principles of honest money. This journey isn't just economic, it's moral and civic. Physical metals, silver, gold, offer resilience, resisting manipulation and central influence. But the road ahead demands vigilance, monitoring supply flows, staying informed of regulatory limits, and recognizing that ownership of honest money brings autonomy. Let's not be passive spectators. Whether preserving individual freedom or shaping a sound monetary system, our choices now echo for generations. The real power lies not in a portfolio, but in an informed, vigilant, freedom-affirming society.
In that light, the defense of sound money is a huge financial concern for everybody. Everybody's worried about their money, whether it's yen or euros or dollars. And it becomes a moral imperative that currency holds its value. It empowers people to live independently, to think long-term, and to resist coercion. It protects sovereignty, both national and individually. Remember, sovereignty simply implies the capacity for self-determination. In other words, you're not ruled by an authority that commands what you can eat, where you can go, what you can say, and what you can do. And gold and silver have served that role for thousands of years, not because they're shiny, because they're scarce, verifiable, and resistant to centralized control. When we have the ownership of money, then we have control. When they own the money and dole it out, they have control. So the digital currency offers new tools to the control mechanism under the guise of convenience. And the battle over money is reaching an inflection point. Who controls it? Well, the banks do. And as they control it, it worsens our ability to make our own free will decisions. And that's just the way it is. So I end that with, we will continue down this path of dependence and dilution, or will we reclaim the principles of honest money and with them the promise of a truly free society? The answer is determined far more than a piece of gold or return to your portfolio. It will determine whether future generations are a free people or managed subjects of a technocratic financial system designed to control, not liberate.